I have argued for many years that because of easy monetary policies, we had rapid credit growth in the Western world and also in other countries, whereby after the Asian crisis there was some deleveraging in Asia. But in general, if you look at the world, say compared to the 1950s, 1960s and even 70s, it's very clear that financial markets, official and less official, have grown disproportionately compared to the real economy. In other words, you have, say, a global GDP, I don't know what it is, $60 trillion or whatever it is, and you have financial markets that turn $60 trillion around in a week or less. And I believe that one day this financial bubble will have to adjust on the downside. Either it will adjust on the downside because we have an inflationary burst, or we have a collapse of the system. We don't know exactly how the end game will be played. But in general, I can't see how, say, the derivatives market will continue to exist for the next 5,000 years. It's going to end one day. And when it ends one day, either through war or through a financial collapse, it will be very painful. I don't necessarily see a disconnect, but we have to distinguish an economy that is essentially balanced and an economy that is imbalanced. If you print money and you have artificially low interest rates, such as we had repeatedly since the 1990s, you create excessive credit growth, you create essentially new financial instruments, you distort the market pricing. And the printing of money by Mr. Bernanke, and essentially we have now in the US a Fed fund rate at 0%. We're now July 2013. The economic recovery in the US began in June 2009. So we're 4 years into an economic expansion, we still have zero interest rates. And we also have a stock market that bottomed out in March 2009. We are July 2013, so we had a 4 years bull market during which, say, the S&P was up 140% or more. And if I look at asset markets, say you have $100 million. You can put it all in the bank, and the bank hardly pays you any interest. And your cost of holding the money in the bank, the charges that the bank will levy on you are higher than the interest you get. So the zero interest rate forces you, and that also applies to pension funds, the insurance industry, and corporations. They force you to do something with the money to earn a slight return, because nobody can deny that the cost of living have gone up in the world over the last few years. It's more costly to buy energy today, to pay for the electricity, to pay for food, and so forth and so on. So money in the bank loses essentially purchasing power, inflation adjusted. So people then, because of these zero interest rates, went and bought high yield bonds. They bought emerging market stocks, they bought gold, they bought commodities, they buy real estate, and so forth and so on. But they don't buy it all at the same time and in the same proportion. So what you then have is that this money printing creates increases in asset prices in some sectors of the economy, because people are also influenced by psychology. So when everybody buys NASDAQ, 97 to March 2000, people rush into NASDAQ because they think it will go up forever. Then it collapses. Then they buy US homes, then it collapses. Then in 2008, they buy commodities, then it collapses. And over the last few years, we had a huge inflow into high yield bonds and emerging market bonds and emerging market securities. And I think that there are distortions. Equally, if you print money in the US, and because we have an international system, the money printed in the US does not necessarily have to stimulate the US economy and create inflation in the US. It can stimulate the Chinese economy, the Vietnamese economy, or any other economy and create inflation in those countries. If you look at monetary policies in the US, I think the cost of living increases in the US are much higher than what the Bureau of Labor Statistics publishes, because in the CPI they exclude food and energy. And also a CPI is a basket of goods and services. Say maybe you have 100 items, and then depending how you weight it, so they underweight things that have gone up a lot in price, like educational costs and health care and insurance premiums. If you would weight it properly, I suppose most people's cost of living are rising at more than 5% per annum, also here in Asia. But the biggest impact on inflation has not been in the US. We had very high inflation in Asia, basically, over the last 10 years. If you want to buy land in Thailand, in some areas, the land price is up 5 times in 3 years. Similarly, in India, real estate prices have gone up a lot. Now, the people that own the land, to some extent, they benefit. But the people that come out of universities and need to buy the land, how can they afford it and build a house? So it creates an unfavorable social climate. And I wouldn't go as far as to say Mr. Bernanke is responsible for the social unrest we had in Libya, Tunisia, Egypt, Turkey, and so forth. But very clearly, when you have an increase in wealth inequality, and as I said earlier, the money printing hasn't really helped the real economy. It's helped asset prices, and it helped essentially people that had assets before, and the financial circle. Then you have a kind of tensions arising in society. And you may say, okay, Gaddafi was not a likable character, but the influence by foreign nations on him came after the unrest in Tunisia, and at about the same time the unrest started in Egypt. And these are not so much religious issues or issues against the leader per se, but discontent in the population, among the people, the middle classes, the students, the workers, because they haven't progressed much. I mean, I can see it here in Thailand. Yes, wages are up, and the government has increased the minimum wage, whereby most people probably don't care about the minimum wage. But the fact of life is the cost of living of these people has also gone up a lot. And so they have to pay more for food. And don't forget, if you earn $1 million a year, what you spend on food is maybe 1% or 2%. But if you earn $1,000 a year, then you spend probably 50-60% on food. So when food prices go up, it hurts you much more than it hurts the well-to-do people.